The evolution of low-payment mortgage refinancing strategies for 2025 introduction. In the mid-2000s, 1% mortgages, loans with exceptionally low initial payments, were prevalent, allowing borrowers to defer interest and prioritize cash flow. However, following the 2008 financial crisis, regulatory changes led to the decline of such products. In 2025, with mortgage rates averaging between 5% and 7% for 30-year fixed loans, homeowners are exploring modern refinancing options and innovative loan structures to achieve similar flexibility and affordability. This article examines current approaches to reducing mortgage payments, their benefits, risks, and relevance in today's market. Modern alternatives to 1% mortgages, adjustable rate mortgages, ARMs. ARMs continue to be a popular choice for lowering initial mortgage payments. These loans offer a fixed interest rate for an initial period, typically 5 to 10 years, before adjusting annually based on market conditions. For instance, a 5-to-1 ARM in 2025 might start with an interest rate of 15% compared to a 30-year fixed rate of 6.94%. Example, savings on a $500,000 loan, securing a 5-to-1 ARM at 6. 15% could result in monthly savings of approximately $300 during the initial fixed period. Caveats. After the fixed rate period, the interest rate can increase significantly, leading to higher and potentially volatile monthly payments. Rate buy-downs. Lenders and builders may offer temporary rate reductions through mechanisms like the 2-to-1 buy-down. This arrangement reduces the interest rate by 2% in the first year and 1% in the second year, before settling at the original agreed-upon rate. This structure provides short-term payment relief similar to the benefits once offered by 1% mortgages. Flexibility. This option is ideal for buyers anticipating income growth or those transitioning into new employment roles. Interest-only (IO) loans. Interest-only loans permit borrowers to pay solely the interest on the loan for a specified period, such as 10 years, postponing principal repayments. While less aggressive than the negative amortization loans of the 2000s, IO loans can enhance cash flow during the interest-only phase. Current rates in 2025, interest-only loans average around 6.7% for 30-year terms. Tax benefits. The interest paid on these loans remains deductible, akin to traditional mortgages. Government-backed programs. Programs offered by the Federal Housing Administration, FHA, and the Department of Veterans Affairs, VA, provide favorable terms for eligible borrowers. FHA Streamline Refinance. This program requires minimal documentation and credit checks, with interest rates as low as 6.23%. VA loans. Qualified veterans can access loans with interest rates approximately at 6.224% and benefit from no down payment requirements. Extended loan terms. Refinancing into a 40-year mortgage extends the repayment period, thereby reducing monthly payments. While this approach increases the total interest paid over the life of the loan, it can align with long-term affordability objectives. Benefits of modern low payment strategies. Enhanced cash flow management. Reducing monthly mortgage payments by $300 to $800, depending on the loan amount, enables homeowners to allocate funds toward paying down high-interest debt, investing, or building emergency savings. Debt consolidation. Cash-out refinancing at current rates, ranging from 6.8% to 7%. 1% allows homeowners to consolidate higher interest debts, such as credit card balances that often carry annual percentage rates between 20% and 30%, potentially saving thousands of dollars annually. Case study refinancing in 2025. Scenario: a homeowner with an existing $500,000 mortgage balance at a 5% interest rate considers refinancing into a 5-to-1 ARM at 6.15%. Monthly savings. The refinance could yield initial monthly savings exceeding $1,000. Strategy. The homeowner plans to use these savings to pay off $30,000 in credit card debt, which carries a 20% interest rate, saving approximately $500 per month in interest payments. Long-term plan. After eliminating the high-interest debt, the homeowner intends to apply the freed-up funds toward the mortgage principal before the ARM's rate adjusts, mitigating future payment increases. Expert predictions and market trends. Rate outlook economists anticipate a gradual decline in mortgage rates, potentially reaching around 6% by late 2025, contingent upon Federal Reserve rate cuts and effective inflation control. Refinance activity. With only 12% of existing mortgages carrying rates at or above 6%, the incentive to refinance remains limited unless rates experience a significant drop. Home affordability. The market continues to grapple with high home prices and low inventory levels, making low payment strategies particularly crucial for first-time buyers. Conclusion: is a low payment strategy right for you? While the risky 1% mortgages of the past are no longer available, homeowners in 2025 have access to various options, such as ARMs, rate buy-downs, and government-backed programs to reduce their mortgage payments. Key considerations include financial stability. Ensure you have a sufficient savings buffer to handle potential rate increases or income disruptions. Long-term goals. Align your mortgage terms with your future plans, whether it's selling the property, retiring, or making other investments. Market timing. Stay informed about Federal Reserve policies and be prepared to refinance if rates decline below 6%. Please like, share, and subscribe to GrowFin channel for more financial insights.